we're going to do the control account. I will go through the notes with y'all before we go to the exercise. The control account, what is the purpose of the control account? The control account will help us to check the accuracy, okay? To check the accuracy of the purchases ledger or the sales ledger. It, other than help to check, it also help to detect the frauds. Fraud means that the intention to cheat the company money. Because control account provide the total. Control account provide the total of the trade payable or the trade receivable. Sales ledger is all the credit customer. So this sales ledger will help us to check with the control account total trade receivable whether agree or not agree. Whereas purchases ledger, it will help to check the trade payable. The information in the control account is obtained where we get the information from the book of prime entry. So take note, the resources or the source of the document for the control account is from the journal, the 7 books that we have learned in the past. The control account contains the total of the posting made to the account in a particular ledger. So take note, control account recorded all the total. Sometimes you will see in other books, they may put trade receivable control account, trade payable control account. Basically, they are the same item, same account. So let's move on to the next. Okay. The benefit, this is more toward the theory question. The benefit of using the control account, first thing, to check the arithmetical accuracy of the double entry for the sales and purchases ledger. If the item in the, but sometimes the control account may also unable to detect, okay, depending on the error that we make. For example, in an item is copied incorrectly from a book of prime entry to a personal account in the sales or purchases ledger, the control account will not be affected as it will revert that an error has been made because the control account taking the total, whereas the personal account in the sales or purchases ledger is recorded individual. If you go through the sales ledger, sales journal or book of prime entry topic, then you should know what I'm trying to say about this. Next, if the total in the book of prime entry is incorrect, control account will be incorrect, but the sales ledger and the purchases ledger will not be affected. The control account will revert the error has been made. So why? Because when you add out the total of the sales or purchases ledger, your total of this book, the 2 ledger, must be equal to the total for the balance carried out for the control account. It also helps us to prepare with the control account that we have the total for the trade receivable, trade payable. So we can prepare the financial statement. And easier for us to know the total for the trade receivable and trade payable. If we want to know whether our staff doing a good job, these 2 accounts, because it's handled by a different person, control account different in charge by a staff, sales ledger and sales purchases ledger will be in charge by another staff. So from there, we will know whether the staff efficiency is there. If the person make a lot of error, that means the person is not efficient. Identify the ledger or ledger which error has been made when there is a difference on the trial balance. When we have a difference on the trial balance, one of the way to quick check is we check these 2 accounts first, control account and the sales ledger and purchases ledger. If the total are same, then the chances are likely to happen, but not 100%. Find missing figure in the single entry. So this one, it will help us to find single error. Single entry means that we forget one side of the double entry. Internal check more toward that to check whether the staff doing a good job, doing the honest job. But the control account has a limitation. What is the limitation that we have? Control account do not guarantee the accuracy of individual ledger, which may contain compensating error. What is a compensating error? Compensating error may be that there's more than one error, two error, three error, that so coincident debit and credit can be equalized. So that is called compensating error. If a transaction is omitted from a book, there is omission, error of omission. Control account also unable to detect on it. If a transaction is entered incorrectly in the book of prime entry, the error will be repeated in the personal account, in the sales and purchases ledger, and in the control account. Means that one of the invoice wrongly recorded the amount. The personal account wrong, control account also wrong. So there is a problem for the limitation of the control account. In theory questions, sometimes they will ask that why in our purchases ledger control account? Purchases ledger control account by right should be recorded the supplier, but supplier should be balance brought down in the credit side. But somehow, sometimes there is small amount in the debit side. The reason is sometimes we overpay the supplier. Sometimes we make payment without forgetting to deduct the cash discount. Goods returned to supplier after payment already fully made. Payment made in advance to the supplier. This is normally when you are new customer, the supplier asks you to pay in advance. Okay, another entry, contra. Contra entry happen is when a contra entry is one which appear on the debit of the purchases ledger control account and the credit of the sales ledger control account. The reason is that there are two or more or one customer, also our supplier at the same time. So where we are owing to the person owing to us. That is in this business. So in this situation, when there is the same person, instead of two parties issuing the check to pay off each other, we choose one party to make the payment for the balance. Good. So that is meant by the control account, okay? To offset the outstanding in the sales ledger control account and the purchases ledger control account. Okay. For this topic, important thing about the topic for this is sales ledger control account is a two account that we need to prepare the account. Most of the time in the exam, they ask us to prepare sales ledger control account or purchases ledger control account, but depending on what we have in the question. The format of it, the key account sales ledger. The debit side, we have balance right now, and this debit is a current asset. This is a current asset in the debit side. It's a fixed, only the amount is different. And debit have credit sales. And take note that do not put in the cash sales. Cash sales is not in the sales ledger control account. Bank, if you have this honor check from the customer, you return back to them. So it's debit side. Interest charge means that you charge the customer because of the late payment or whatever issue. End of the month, you may have some customer, we are owing them. So this will become a liability. So this is our liability, end of the month. So end of the month will transfer to the following beginning month. So in here is from the last month. This last month means that some of the customer will owing money, and this is our liability, current liability. Okay. Credit side, we have bank, we have cash, depending on the payment mode. Discount allowed always together with the bank or the cash, same side. Sales return is opposite to the sales. Bad debt or irrecoverable debt, the new term for the account is we call irrecoverable debt. Contra entry, which is we deduct one or two customer due to the same supplier as well. Balance carried down, balance brought down was complete. And take note, these two items, cash sales, provision for doubtful debt, will not appear in the sales ledger control account. Okay, this is an example sometime where is the resources we can gather the document. So for example, sales, where we gather the information, sales journal. Sales return journal. This is all total. Receipt from credit customer, cash book. Discount allowed to credit customer, cash book. Dishonor check, cash book. Refund to the credit customer, cash book. Irrecoverable debt written off, interest charged on the overdue account in the general journal. Whereas purchases ledger control account, the source of document for purchases is from purchases journal, purchases return journal, payment to the credit supplier, cash book, discount received from credit supplier, cash book, refund from the credit supplier, cash book, interest charge on the overdue account, journal. Purchases ledger control account. Debit side is given to the supplier. So we see the credit side first. Credit side balance brought down is a liability. So this is the current liability. Double entry for purchases is debit purchases, credit trade payable. So this is a trade payable, purchases ledger control account. This is in the credit side. Take note, all these accounts are fixed. It will not change the other way. So only the account amount change. Interest charge means supplier charges us the interest. End of the year or end of the month, there is a balance carried down small amount means that the supplier owing us the money. Balance brought down. This one small amount, which is that from the last year or from the last month. Purchases return always opposite to the purchases account. Cash because we pay to the supplier, so cash or bank account is this detail is in the debit side. Discount received always together with the cash book or bank. Contra entry is in the debit. Balance carried down large amount transfer to the credit side, which becomes the current liability. So basically, this account, these two accounts, the position of the debit or credit are fixed. Only the amount in the question will change. Okay, that's all for my notes for today. So after that, there's an exercise to watch. So take notes on it after practice your own exercise.